Okay guys, we're going to go ahead and finish up chapter 13. This is going to start on page, hold on, let me get this fixed, sorry. There we go. On page 10, actually page 12, sorry, that's the old book edition. So page 12, starting out with accounting for common stock. The biggest objective for a corporation is to identify the source of paid-in capital. Where is this coming from? And then the second one is to maintain the distinction between contributed capital and earned capital, or PIK and retained earnings, like I talked about at the end of the last video. Issuing par value common stock for cash. This is the easy peasy one. If you are issuing, remember par value is the amount of legal capital we're going to assign to each share of stock according to the charter. So there has been a dollar value assigned to it. So let's look in the book at the example. It's on page 12. It says, to illustrate, assume that Hydroslide Incorporated issues 1,000 shares of $1 par value common stock at par for cash. So it's going to get $1,000, $1 per share, to issue 1,000 shares. So the first thing we do is start asking ourselves questions. The first one is, what did we get? Well, we as a corporation got cash. How much cash did we get? We got $1,000. What are we giving up for that? Well, we're giving up common stock. Remember, so far that is the only one you know about, so that's the only one you're going to use. And this is at par. Okay, so par and, take that glare off of there a little bit for you. Par and that value is 100% exactly the same. So cash is your debit for that value. Common stock is what you're giving up, 1,000 shares. Okay. Now let's assume that we are now going to sell it at more than par value. So right underneath it, assume that we're going to issue an additional 1,000 shares of the $1 par value common stock now for $5 a share. At this point, I kind of start doing some calculations in my journal entries so I can keep track of things. So we're going to sell this above par now. We're getting cash, just like we did before, but I always put the math in. How many shares am I selling? I'm selling 1,000 shares at $5, which means that I'm going to make $5,000 here, or bring in $5,000. What am I giving up for this? Well, I'm giving up common stock, just like I did before. But I've got to do some math here because common stock goes in at legal capital. In this case, par value. We have a par for this stock. It's the same company. It's the same shares of stock that they're authorized to sell. So we're going to give up 1,000 shares. And we are going to multiply that times the par value rate, which according to the charter is $1 per share. So we're going to put $1,000 over here in the credit column for common stock because it's 1,000 times the par. Anything that you get above par, the difference between these two numbers, the $4 per share, would be considered PIK, paid-in capital, and then you tell me on what kind of stock. So it's PIK on common. So PIK, P-I-C, paid-in capital, on common. Oops, I abbreviated that, CMN. Or, and I don't even write the on sometimes, I just say PIK common. So I know it's paid in capital from where? From common stock, okay? And that is going to be the difference that it takes to make these two balance, the 4,000. And that is being sold above par. Okay? So that is how we're going to handle it when we sell at par and above par. Now, if we sell, well, let me tell you what you need to know for the test. Sorry, I have something highlighted. The proceeds above and below par value is going to be recorded in this pick in excess of par value common stock. So if I sold some for $3 now, for 50 cents now instead of $1, I would pull from here as a debit because this account has a balance in it. We'll get into that in just a few minutes. But this is going to be like your slush account. Anything above par goes in it. Anything below par comes out of it. Okay? Now, if it is issued for value less than par and the PIC account doesn't have a credit balance in it, then you have to debit retained earnings. Okay, so they use up anything contributed first, and if there's nothing else there that they can pull from because they're having to sell it at such a reduced rate that they've used all their PIC on common, then they have to dip into their retained earnings, their actual earnings from doing their business. So then you would debit PIC for what you can, and then debit retained earnings for anything different that you would need to make that up. We'll see one of those here in a little bit. Issuing no par value common stock for cash. Common stock with a stated value, which is done by the board of directors. Remember, these were done with par, which was done in the charter. Stated value is the value that is assigned by the board of directors. This could just say that they issued 1,000 shares of common stock at stated value of $1 per share, and this would not change. Okay? This would not change if the stated value was $1. You treat it just as if it were listed in the charter as par. Okay? Only this would now say paid in capital in excess of stated value, not par value, but I don't even write all that out because it's too much. I just say pick on common, and you would use pick on common either way. Okay. Common stock without a stated value, if there's no par value, there's no stated value, then everything becomes legal capital. Okay, so go to page 13. We're going to take a look at the differences here. The first one says, for example, assume that instead of $1 par value, Hydroslide has a $5 stated value. No par common stock in the company issues 5,000 shares at $8 per share for cash. So in that case, you're going to debit cash for the 5,000 times the 8, or the 40,000. You're going to credit common stock for the 5,000 times the $5 stated value, so 25,000, and then the excess of 15 would go to PIC on common. Only it's not paid in capital in excess of par. If it's all written out, it says paid in capital in excess of stated value. That's the only difference. If there is no stated value, there's no par value in the charter, then this is how it looks. You would have to debit cash in the next journal entry there for the 40,000, just like you did above, but then you would be forced to debit or credit your common stock for the full 40,000 as well, because there's no par value for establishing a legal capital, there's no stated value to establish a legal capital, so everything you get in that cash account then is what you have to put against common stock as legal capital. Okay, so par value, stated value, those are considered legal capital, and if you don't have them, then you got to put it all there. Okay. Now, we can also issue common stock shares for services or non-cash assets. Know for the test that the cost becomes the fair market value of the item given up, your shares of stock, or the fair market value of the item received, whichever is more easily established. We're going to go through some examples here in a second, but I'll repeat that. The cost becomes the fair market value of the item given up, your shares of stock, or the item that you get. Okay, so whichever one you can get the fair market value of most easily. Let me give you a little hint here. If you are told the trading or the current market value of the shares of stock, that's probably the one you're going to have to use. What you're giving up, your shares of stock. We're going to talk about the fair market value of what you're getting, and when we work through this next example here. Page 1313 at the bottom. To illustrate, assume that the attorneys have helped Jordan Company Incorporate. They have billed the company $5,000 for their services. They agreed to accept $4,000 4,000 shares of $1 par value common stock. So the incorporating attorney's office has sent us a bill for $5,000. And they have agreed to take 4,000 shares of our $1 par value shares of stock. Okay? So, what am I giving up? I'm giving up 4,000 shares of par value common stock. So, it's par value, not market value. So, I don't have a fair market value for those shares of stock. But I do know what I'm getting. I'm getting $5,000 worth of attorney services. So therefore, that's what I have to use as my value. So I'm going to say I am getting organization expense, which is the account that we said we're going to use for that type of stuff. How much service did I get from them? I got $5,000 worth. What did I give up for it? Well, I gave up common stock. How much did I give up? I gave up 4,000 shares at legal capital rate of $1 per share, because that's my par. So 4,000 times 1, $4,000 worth of common stock. I can't be done because rule number 2 is not in effect. Debits do not equal credits. The difference then would be pick on common. This goes in only legal capital, my par value. But the value of this is determined according to what I gave up or what I got. I don't know the fair market value for my shares of stock. I was only given the par value for my shares of stock. But I do know what the attorney services were worth. I got a bill for it. Okay? We are going to flip at the bottom first, and then we're going to flip the page. But it says, in contrast, assume that the Athletic Research Corporation is an existing publicly held corporation. Its $5 par value common stock is actively traded on the market price of $8 per share. Did you hear that word, market price? Good clue. The company issues 10,000 shares of stock to acquire land, recently advertised for sale at $90,000. I'm glad they put that in there. So, we know that we are getting some land. We want to determine the value of that land. Okay, we're told a couple of different things. That in exchange for that land, we're giving up some shares of stock. We're giving up 10,000 shares. Okay, it has a $5 par value and an $8 market value. I know the market value. That's a good clue. I also know that I'm getting land that was recently advertised at a price of $90,000. Now, here's a little thing about that. I don't know if you've done much real estate looking or buying, but you can advertise your land for whatever price you want, and it doesn't mean diddly squat. The only time it matters, price-wise, is when you find somebody who's willing to pay that price. So I've got 39 acres. I could advertise that for $1 million for a million years because it's not worth $1 million. So I'm never going to get $1 million. So when it says the asking price on something is, that really doesn't matter. That doesn't set the value of that. That's just a price somebody's thrown out there that says, hey, you want to pay me this? Because if you do, I'll give it up. What matters is I know the value of the shares of the stack that I'm giving up because they are actively traded on the market and they're right now being traded at $8 a share. That's a solid no. Okay, so what am I getting? I'm getting land. And that's the one that we want to establish the value of. Well, what am I giving up for it? I'm giving it because I can't go with what they gave me on the land because it's just an asking price. You can ask whatever you want, but unless somebody's willing to pay it, it don't matter. So let's go with what we know. We're giving up 10,000 shares that are being traded on the market at $8 per share right now. So if I did the math there, then that land would be worth $80,000. Okay, what am I giving up? I'm giving up common stock. Well, how much? 10,000 shares at a legal capital of $5 par. So $50,000 worth of common stock. And the difference, again, goes to pick on common. So that's how you would record it if you know the value of the item being given up, your shares of stock, not necessarily the land. Okay? We are going to go back and actually work some of these so that you can see how this looks so far and get a little bit more practice. So we're not going to lose our spot. We're going to come back and talk about the next section, but we are going to go back to the brief exercises. We're going to look at brief exercise 3, sorry. And that will be on page 26. On May 10th, Jack Corporation issues 2,000 shares of $10 par value common stock for cash at $18 per share. Okay. Well, if I'm issuing shares of stock, then somebody's paying me cash in this case. So I know I'm getting cash. How much cash? Well, let's figure out the math. How many shares am I giving up? 2,000 shares at $18 a share. So 2 times 18 is 36. So $36,000 in cash is what I'm getting in. What am I giving up? I'm giving up common stock. Common stock must go in at legal capital. So I know I've got 2,000 shares. And the legal capital of it is the par value of $10 per share. Or 20,000. The difference of 16 has to go to pick on common. So that's exercise 3. We're going to look at 4. It says on June 1st, Noonan Incorporated issues 4,000 shares of no par common stock at a cash price of $6 per share. Journalize the issuance of the shares assuming that the stock had its stated value of $1 per share. So we are going to issue it at a higher value than our legal capital. So I'm going to go ahead and leave the basics on here. And then fill in the details. We're issuing these shares of stock for cash. We want to know how many. We've got 4,000 shares being issued. And it's being issued at $6 per share for $24,000 in cash. We're still issuing the same 4,000 shares. But the legal capital now on these shares of stock is $1. So 4,000 goes in common stock, 20,000 goes into pick on common. Hopefully this is coming easier and easier. Number 5 says Leah's Incorporated, $10 par value. Common stock is actively traded at a market price of $15 per share. Leah issues 5,000 shares to purchase land that's advertised for sale at $85,000, and we're going to issue or journalize that issuance of stock for land. Now again, you want to pay attention. Am I just being told the asking price for this land, or is it giving me a market value? Well, it said asking price. So I'm already going to put a line right through there, because it doesn't matter what anybody asks for anything unless somebody's willing to pay it. Then is when it matters. So we're going to go ahead and I'm going to erase all this. We're going to start off by writing what we're getting, which is land this time. And I can't go by their asking price because that's not market value. That's just their value on the land. So I have to go by my stock price. I'm giving up 5,000 shares. And it's price that is on trading on the market for is 15. So 5 times 15 is $75,000 value. We're giving up common stock for that. Still 5,000 shares. And its common or par value is 10. So 50,000. The difference is 25. Giving up common stock, so it's pick on common. So that gives you some examples on common stock. We're going to talk about the next kind. I am actually going to have to shut this off at about 23.5 minutes here and do another video. Sorry guys, I just got a call. I let it go to voicemail, but I do need to take it. So you'll have 3 videos, hopefully all on this one. So be back in a few.